and welcome to the Tega Industries Limited Q4 FY22 results conference call organized by Orient Capital. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nachiket Kale from Orient Capital. Thank you, and over to you, sir.
Yeah, hi. Thanks. So, good afternoon, everybody. Welcome to the Q4 and FY22 earnings conference call of Tega Industries Limited. Today on this call, we have Mr. Mehul Mohanka, who is the Managing Director and Group CEO, along with Mr. Syed Yaver Imam. He is the Director of Global Product Group, and Mr. Manoj Kumar Agarwal, Director, Global Finance and Chief Financial Officer and Company Secretary. So before we begin the call, just a small disclaimer that this conference call may contain some forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. Actual results will differ materially. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. A detailed safe harbor statement is also given on page 2 of the company's investor presentation, which has been uploaded on the stock exchange and company's website. Now, I would like to hand over the call to the management, Mr. Mehul Mohanka. Can you please take over?
Yeah, thank you, Nachiket. Good afternoon and a warm welcome to all the participants. I am joined this afternoon by my colleagues, Yaver, who is the Director, Global Product Group, and Manoj, who is the CFO of the company. I hope by now everyone has had the opportunity to go through our financial results and the investor presentation, which has been uploaded on the stock exchanges as well as the company's website. The financial year 2022 was an eventful one and marked a milestone in our history, as the company listed itself on both the NSE and BSE in December 2021. As this is only our second earnings call, I would like to give a brief description about the company before we move on to our performance for the fourth quarter financial year 2022. Tega Industries Limited is the flagship company of the Tega Group of companies. The company commenced its operations in 1978 in India. We are the leading manufacturer and distributor of specialized, critical-to-operate, and recurring consumables products catering to the global mineral beneficiation, mining, and bulk solids handling industry. Tega is the second largest producer of polymer-based mill liners. We have more than 55 product portfolios spread across multiple geographies. Our products are installed in more than 450 customer sites in about 70 countries. We have close to 18 global and 14 domestic sales offices across the world, with about 88% of our revenues from operations generated outside of India. In this fiscal, despite being faced with multiple macro challenges, we have emerged stronger and are progressing as per our strategic plans. Ongoing supply chain disruptions, rising fuel and commodity costs have had an impact on our margins. Uncertainties related to the geopolitical issues and COVID lockdowns across various countries have created a challenging external environment for us. However, we remain resilient in the underlying strength and performance of our business. We are happy to announce that despite these headwinds, we delivered continuing growth in the fourth quarter of this particular financial year across key financial parameters. We are encouraged by the opportunities in front of us and are committed to building a true homegrown global powerhouse in our industry. We aim to generate value and deliver as per our plans over the long term for all our stakeholders. Now I would like to hand over to my colleague Manoj to take you through the financial performance of the company for the period under review.
Thank you, Mr. Mohanka. A very good afternoon to all the participants. I hope all of you and your family are in good health. I'll share the highlights of our performance for the quarter and the year following, which we will be happy to respond to queries. For the Q4 performance on the consolidated basis, the company's operating net revenue has gone up to 290 crores in quarter 4 FY22 as against rupees 250 crores in FY21 Q4, delivering a growth of 16.6%. Operating EBITDA stood at 69 crores which is a jump of 25.2% against quarter 4 FY22 same period. Operating EBITDA margin stood at 23.8%. Operating PAT increased to 48.9 crores in quarter 4 FY22 as against 41.1 crores in quarter 4 FY21. On a full year basis, your company reported a revenue of 952 crores against 805 crores in FY21, delivering growth of 18.5%. Operating EBITDA stood at 183 crores for FY22, which is 19.2% of revenue. Operating PAT stood at 117 crores against 136 crores in FY21. If I had to normalize the PAT by adjusting non-operating income, the PAT stood at 85 crores, 90 crores against 85 crores FY21. So now we can open for the question answer from the participants. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may enter star and 1 to ask a question. The first question is from the line of Abhishek Jain from Arihant Capital. Please go ahead.
Thank you for taking my question. I have few questions. First thing, in terms of growth, hello?
Yes, we
can hear you.
We can hear you. Okay. So, what kind of growth we have seen it from Dynaprime and what kind of growth we are seeing in other segments right now?
Yeah, thank you for the question. So, Dynaprime, we have grown about 33% YOY from 172 crores to 229 crores in FY22. Okay. And on the non-Dynaprime mill section, we grown at about 16% from 409 crores to 475 crores.
Okay, sir, because we have just started looking the company, if you can throw some light on what kind of, in terms of our product portfolio, which are the products are going to be used even if then a slowdown is there, like CapEx related and maintenance related, if you can highlight on something on this also, would be really helpful.
So as we mentioned that all our products are consumables in nature and are OPEX related. So irrespective of any slowdown, our products are used as spares in the plant. So as long as the plant is operating, they would need our products. And that's across all our product segments.
Okay. And third is what kind of, apart from Dynaprime, any other products which you are talking about right now going forward will do very well? And on the margin side, are you facing any pressure on the raw material side?
So in your company, basically we talked about 75% of our volume comes from the mill liner, which consists of both Dynaprime and non-Dynaprime. And 25% consists of non-mill liner, which consists of different product segments required in mill processing. We talked about wear product, screen, trommels, hydrocyclone. So the growth will be coming from there as well, but the growth will driven from the Dynaprime going forward because we are basically disrupting the steel market. And the idea is to take over steel market to the extent possible through the disruption of hybrid liner, which is Dynaprime.
Okay. Okay, and margin?
What is the next question?
Margin.
And margin, basically, as our MD said, that's more of a critical to spares. So we have been able to pass on the prices to the customers gradually. And you will be seeing that on a year-on-year basis, we have been able to maintain close to 60% of our RMC margin. This year, we are short of around 2% of our expected 60% RMC margin, with the fact that the increase was, abnormally stiff entire year. So generally it takes 1 to 2 quarters, which is taking 2 to 3 quarters now. So we are lagging about 2% from our target of 60% RMC margin.
Okay. Thank you, sir.
Thank you.
Thank you. A reminder to participants, if you wish to ask questions, please enter star and 1. The next question is from the line of Amit Shah from AT Capital. Please go ahead.
Hello, sir. Thank you for giving me this opportunity. So my question is more around the volatility that we are seeing in currency and the commodity prices. I would like to understand how does that impact both our top line and EBITDA, and are we taking any proactive measures in terms of hedging?
Yeah, let me come to the forex part first. So, as a company, there is a policy of hedging the currencies. So, we do hedge the currency on a real-time basis. Now, as far as our impact on the accounts is concerned, on the console basis of forex, the top line has gone up by 20 crores on the forex translation, and EBITDA will be about close to 3 crores on a forex translation. So, on the top line, 20 crores, on the bottom line, 3 crores, as such forex translation is concerned. On commodity.
On the commodity prices, yes, we are seeing some volatility in terms of price movements on our input costs. But as we had mentioned earlier, we've always been successful in passing through those increases to our customers. We generally see a 1 to 2 quarter lag in passing on these increases to our customers.
Okay. And the pass on is 100%?
Yes, invariably it's 100%.
All right. Thank you. This is helpful. Thank you. Good luck.
Thank you. The next question is from the line of Pritesh Vora from Mission Holdings. Please go ahead.
Sir, I want to understand the working capital cycle has deteriorated. And I had not joined from the beginning, so I missed that call on the EBITDA margin. Why the EBITDA margin has declined this year? And I want to understand why the deterioration of working capital cycle. Now working capital is close to 165 days. So is this a norm in your company? I mean, I can understand from 2-3 years back it was around 120, 130 days, and now it has increased. So what is the reason for this working capital cycle?
Yeah, thanks for the question. So you're right by saying that the norms, what we follow is 120 to 130 days. Even FY21, we were at 130 days. Now, if you see here that the inventory is mainly the reason for the working capital cycle goes up. And it was a strategic decision by the management to ensure that we kept our inventory higher with the disruption in logistic supply chain globally, and we do both export and import for our production purposes. So idea was to ensure production should not disrupt, and our customer, because in a critical space, we will be able to feed them on time so that we don't lose them. And hence, this time we are at about 30 days higher than the normal, which was a kind of a strategic decision. And second is that you can also see that because of inventory, what we have with us, it also helps us to manage the margin because of the lower carrying cost of the inventory, what we were having.
But your EBITDA margin has declined. What is the reason for EBITDA decline?
Coming to that. On EBITDA side, there are two reasons. One is, as I said, that because of the abnormal increase in the prices in the entire last year. So as our MD said that generally we pass on the price in 2 quarters. Quarter 1, quarter 2 kind of things, the lag is there. But this time it's taking 1 more quarter. So if you find there's a lag of about 1.5% on the margin side, which we need to pass on. And second is that the logistic cost. Now our logistic cost is again going very, very high, which is about 1.5% incremental logistic cost to revenue. Now, as we said last time also that we cannot and will not be able to pass on the entire logistic cost burden to the customers. So that hit coming to us. And what we see also this entire H1 this year also, this logistic cost will be challenging for us. So if we talk about this normalization of 1.3 into 3%, we are at about 22.5% EBITDA.
Okay. But I could see some of the previous years, for example, your EBITDA was in 1920 is around 16%. And previous to that, 18 was around 13%. I think IPO year was abnormal and your operating margin has increased to 24%. So are you confident that will you able to maintain such a high margin, or you go back to your normal 19, 20, 16% margin?
So our normal EBITDA margin raised to 21 to 23%, and in our IPO also we said the same thing. We are an operating leverage company. So any increase in volume gives us a good kind of, EBITDA margin to us. And even last year also normalized EBITDA was 22%, which we've already said in our call to the investors. So we are of the range of 21 to 23 kind of EBITDA margin, which we believe that we should be in that range. Of course, there are certain kind of headwinds this year, as I said, because of the abnormality in the commodity cost and logistic cost. Otherwise, the range should be around 21-23% going forward.
Okay. And how is I understand our Chile plant is just starting, right? So how do you see the volume growth going forward, and how do we assess the growth of the company going forward?
So the new project in terms of the new greenfield plant is not yet started. So I just wanted to make that factual correction. But in spite of that, though that's planned for the subsequent year, the traction for our product lines in Chile is very, very good. I mean, most of the growth that you see in Dynaprime that we earlier spoke about, the hybrid lining system has come from that jurisdiction. And we remain buoyant with the fact that that market is growing very well for us.
Okay. So
when does the new green... Sorry to interrupt. I would request you to please come back in the queue.
Thank you.
Thank you. The next question is from the line of Abhishek Poddar from HDFC Mutual Fund. Please go ahead.
Hi. Thanks for taking my question, sir. Sir, regarding the Dynaprime, if you could share some plans regarding what internal targets you are looking at for growth in 23-24.
So, I think in the initial calls and even in the IPO, we had said, that the growth in Dynaprime will continue to be at a CAGR between 25 to 30%. And that is what we are. We are delivering that this year also. And for the next couple of years, I think we will be on that same trajectory.
Understood. And the product mix change, meaning Dynaprime being a higher contribution to the overall revenues, what impact does it have on operating margins?
No, I think as far as Dynaprime is concerned also, the margins are similar to that of the other mills also. So the difference will not be too much as far as the margin is concerned. Again, as far as quarter to quarter this thing is there, we will be looking at how we are passing on the cost increase if further cost increases there in the next 2 quarters. So I think margin will be as what it is there, both for Dynaprime and for the non-Dynaprime mill products.
Understood. And so the forex impact for the full year, is it there in other expenses, and what amount it would be for 22?
In other expenses, it is about 2 crores impact on forex.
For the full year, sir?
For the full year.
And if you can give the number for 21 also, sir?
21 will be around close to 1.5 crores.
Okay. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity. Could you help us with what has been the growth in the non-mill liner business, and if you could give us a flavor about what's the contribution of some of the critical segments in that, which is like the trommels and chutes, etc.?
So I think in the non-mill section, we have grown year on year by 6.2%. Okay. And major contribution has come through the mill and trommel. Okay. And hydrocyclone has also picked up over there. These are the 2 major components on which the growth has come from.
Sure. So what we've been given to understand, these are actually these products have a pull factor, like the customer who kind of accepts the Dynaprime, and there is a tendency to kind of accept some of our non-mill liners like the hydrocyclones, trommels, conveyors, etc. Do you see that that this growth can actually accelerate in the years to come?
I think this question, we had taken up in the last call also. What is going to happen is that we are in the acquisition stage as far as Dana Prime sites are now. So our concentration is there to get into the major mines and get a market share on the Dana Prime. Once the Dana Prime we establish over there, and it will follow up with the other product line. And it's right to say that going forward, we will get some tailwind on the non-Dana Prime products once the Dana Prime products are fully established in the sites which we are accessing now.
Okay. The second question is if you can just help us, what has been the growth in the Chile? So what's the revenue and EBITDA current year versus last year in the Chilean subsidiary?
Yeah, Bhavesh, I can take this question. So Chile has grown at around 25% this year on the top line side, and on the operating profit side, Chile has done about 19%.
Okay, and how do you see the growth going forward, and what's the current capacity utilization? You did mention about a greenfield expansion there.
We are just expanding this quarter we are going to expand the capacity over there by addition of another press. And at the end of by the end of the year, we also plan to add another couple of presses. So based on the development that's taking place, we are taking action on the increase of the capacity in Chile.
And on the freight side, last time we had mentioned that we are focusing and the endeavor is to actually move the contracts from CIF to FOB so that the freight impact doesn't come to us. So where are we in that journey?
So, Bhavesh, as I said last time also, we are trying to kind of discuss customer wherever possible to convert into FOB. But not many of the customers have come to FOB because they see the landed cost. So though we have been able to move some of the customers, but that not kind of help us to reduce the logistic cost per se, because ultimately customers talks about their landed cost. So it is not kind of happening very, very fast in terms of changing the Inco terms. And as you know, in the business also, we can't press them to change the Inco terms. So we are doing kind of multiple action in terms of either trying to convert to FOB or asking them to or requesting to share the kind of logistic cost to some extent. So with that, we are doing some kind of price rationalization. But even having said so, the entire logistic cost pass on will still be difficult.
Sure, no understand. Last question: what has been the revenue and margins for Australia and South Africa?
So for South Africa, the revenue jump was about close to 35% YOY, and EBITDA was 17.5%. Again, as I said that for us, EBITDA margin looking at subsidy-wise may not be the correct way because there are many shipments happen from India also. So volume-wise, they have grown up by 33% as far as Africa is concerned, and Australia also grown up about 40% on the top line side. And EBITDA, they have come to now positive. Earlier they were break-even. They had about 3% EBITDA this year.
Sure. Yeah, thank you so much for taking my questions.
Thank you. The next question is from the line of Neeraj Prakash from White Oak Capital. Please go ahead.
Yeah, hi. Thank you for taking my question. I just wanted to know if you can break up the volume and value growth for the fourth quarter as well as for the entire year.
So for the entire year, if I break the volume growth is about 10%, and the price is about 6%, and exchange is about 2%.
And for the fourth quarter?
Fourth quarter is volume growth is about 5%, price is about 10%, and exchange is about 2%. Quarter on quarter.
Sure. Understood. Thank you. And on the margin front, I just, I had a follow-up to maybe a previous participant's question. In terms of the gross margins, what would the differential be between Dyna Prime, the non-Dyna Prime, and the rest of the portfolio? And I think, if I'm not mistaken, you mentioned that Dyna Prime and the mid-liner portfolio is growing faster than the non-mid-liner portfolio. So as this mix improves, should we see this gross margin in the longer term trend above the 60% number?
No. So, as Mr. Yawar said that the mid-liner margin both for Dyna Prime and non-Dyna Prime will be more or less same, because the idea is to just go into the market and increase the market share. And the non-mid-liner, again, it depends on the acceptance of Dyna Prime in all the mills where we are running now, and that give a traction to increase the non-mill product mix in those plants. As far as margin is concerned, non-mill generally carry the little higher margin than the mill segment. But overall, we talked about RMC margin of 60%. That is what we are aimed for.
But you are correct that if the overall growth in non-mill does happen as we have planned, the margins will improve beyond the 60%.
Sorry, the growth in the mill liners or the non-mill liners?
The non-mill.
Okay. And in terms of the EBITDA margin translation for this, we've seen in the fourth quarter you had a very strong EBITDA margin performance, close to 24%. A lot of it was driven by the operating leverage on other expenses. Is this something that is sustainable going forward? Assuming you maintain this level of sort of revenue on maybe a run rate basis, adjusting for maybe some seasonality, is this sort of operating leverage sustainable, and can this sort of 23% type of margin sustain, assuming, steady state gross margins, and I'm not taking into account fluctuation in raw material prices?
Yeah, so we've always maintained that in our business, anywhere between 21 to 23% EBITDA is a sustainable range. Of course, given where the operating leverage is, Q4 is a good reflection of how, operating leverage impacts our EBITDA positively. But we do have, as we had earlier explained, that the lumpiness in the business, that you cannot take one quarter and multiply it by 4. We tend to see the first quarter to be a bit slower than the rest of the quarters, and we see the revenue and EBITDA trend up starting from Q2 onwards.
Sure. Thank you. Just a last clarification from my end is, I didn't catch, what is your normalized working capital cycle going forward?
130 days, 130.
Sure. Thank you so much.
Thank you. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Just wanted to clarify the greenfield
capacity.
Sorry
to interrupt. Please, can you please speak a little bit louder?
Hi, am I audible now?
Yes.
Yeah. Good afternoon. Thank you for taking my question. Just wanted to understand the greenfield capex that we were talking about. What is the quantum we're looking to incur, and by when is it expected to come on stream?
So we are looking at about $20 million of spend for this greenfield, and this will target to commission sometime last quarter of FY24 or first quarter of FY25.
Okay. And what did we say our contribution from Dyna Prime to our overall revenue was?
It's about 25% mix of overall revenue.
Sure. And we expect this to continue to grow at 25 to 30%. This is in volume terms that you were referring to?
Yes. So that is what is our aim, to grow about 25% CAGR for next few years.
Sure. And while we've done about a 10% kind of volume growth in 22, what is the kind of volume growth we're targeting for 23?
So again, we can't give any forward-looking statement here in this call, but the aspiration is to grow overall in the company in a double-digit growth.
Okay, thank you.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yes, sir. Just a clarification. So in case of Dynaprime, our sector dependence will largely be mining, right? It will be these sag mills and largely related to gold and copper and iron ore, right?
Yeah, largely dependent on gold and copper. Okay. And you're right, it will be major sag mill. Larger operation where the sag mills are very high in the diameter. We have also ball mill of similar sizes of 18 feet and above. So we are looking at both ball mill and sag mill combination for Dynaprime for large copper and gold operations.
And what will be your sector dependence be in case of non-Dynaprime and non-mill liners?
For non-mill liner, again, there are non-Dynaprime, again, copper and gold, which we said because of the volume that copper and gold has. So mill lining business is close to around 75 to 78% concentrated in copper and gold. Okay? We have other sectors, but platinum or zinc or lead or uranium and iron ore because of the nature of available iron ore, grinding is quite limited to only a few territories. So dependence on copper and gold will continue to be very high because today 75% lining business is concentrated in copper and gold. For non-mill, we have a range of this thing. It's iron ore, steel plants, aggregate, and power and cement.
Okay. So what will be your growth expectation in case of non-Dynaprime and growth expectations in case of non-mill liner?
So as I said that as a combination, we are looking at double-digit growth, and maybe we don't intend to give any forward-looking statement in this call, but the idea is to carry over with the growth on all the segment with a kind of disproportionate growth from Dynaprime.
And my last question is, sir, in case of Dynaprime, where are we in the sales, in terms of the sales cycle with our customers? Or at what stage are we with the customers? Because my understanding is that globally you have fairly strong, larger customers in the 75% of the area which you mentioned, which is copper and gold. Where are we in terms of product trials, product acceptance, product, in these larger or more significant customers? And I think they also would have mine-wise approval. So if, let's say, if it is a billiton, BHP billiton, and if it's a BHP billiton Australia or a BHP billiton Latin America, both of these have to give separate approvals to you. So where are we in the whole sales cycle?
As far as Dynaprime is concerned, if you see for the past 3-4 years from zero business in 2018, we have come to close to now $32 million. Okay, and today the number of sites in which this is working, there a lot of traction is happening globally on this. So customers have started looking at this as a product which has delivered in the last couple of years. So going forward, this will accelerate. We have also increased the concentration of marketing effort in non-Latin area, Latin American area, so that our base as far as the trial and other discussions is on a now wider base. And that is the reason we are continuously looking at that the growth in the next 3-4 years will continue at the 25 to 30% CAGR rate.
Okay. And when it comes to this greenfield expansion at Chile, or let's say any expansion that you do, these would be facilities which could do both, right? They could do Dynaprime and non-Dynaprime mill liners, right?
That's correct.
Okay. Thank you and all the best to you, sir.
Thank you. The next question is from the line of Balasubramanian from Arihant Capital. Please go ahead.
Good afternoon, sir. Thank you so much for taking my question. So the additional larger plant in Chile, like what kind of capex and what kind of timeline?
Can you please little louder? We are just struggling to hear you.
Yes, sir. Sir, in larger plant in Chile, additional larger plant in Chile, what kind of cost estimations and what kind of timelines you have, and what kind of demand you are experiencing in Latin American markets? And what kind of revenue potential from that additional larger plant for next 3 years?
So as I said, for Chile, we're talking about close to $20 million of spend for the new capex greenfield project, and that we are targeting to commission sometime in Q4 FY24 or Q1 FY25. That's a target, and that will take up our capacity where we are today to threefold from there itself. It will take up the capacity to close to about $70 million, 70. And I could not take your second question, if you can repeat that.
Yes, sir. So, like, this plant majorly focused on which markets?
So, this plant will take care of entire Latin region, South America, which consists of Brazil, Chile, Peru, Argentina. So, those entire Latin, they will cater.
Sir, what kind of demands you are experiencing right now?
So as we said that demand is absolutely in line with our expectation, and we are disrupting the steel market. So we are pretty sure that demand will be in our favor going forward.
Okay, sir. Thank you.
Thank you. The next question is from the line of Roshan Ponikar from JM Financial. Please go ahead.
Yeah, hi. Sir, can you give the ore-wise breakup for the last year in terms of revenue?
What do you want? Sorry? Ore-wise?
Ore-wise breakup, yeah.
What breakup? You are talking about the ore-wise breakup revenue or what?
Revenue.
So ore-wise breakup, as Mr. Yawar said, that about 72% we are supplying to copper and gold together, and there's 28 mix of many of the minerals. Talk about iron ore, platinum, titanium, diamond, zinc. So mix is in that range of 72 in gold, copper, and about 28% rest of the commodities.
All right. My second question is in terms of Dynaprime, sir. How many sites currently are using Dynaprime, and how many new sites are under the prospect, as in under the trials and other processes?
So Dynaprime, as far as the customer is concerned, is also a journey where he is going through, different process of trial and a larger portion of mill as an order, and then it goes for the full. So as of now, totally around 45 sites are there where we are working with Dynaprime in various stages, including trials and where we are getting orders also.
Okay, so this 45 number includes the sites where we are already supplying and which are...
Yeah, it includes that.
Okay. And the capex estimates for FY23 and 24, that will be my last question.
So capex estimate for FY23, we're targeting about close to 70 crores in our capex, majorly in Chile, which includes land also, and about 30 crores of sustaining capex. And the same will be for FY24.
All right. Thank you. Thank you so much for answering my questions.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity. Just one question. Metso, in its earnings call, mentioned that they are exiting Russia, and Russia is about 500 million euro of revenues out of 5 billion euro of revenues they do. Are we actually taking any actions to see that we can capture some of the market that these large multinationals will vacate in Russia? Any trial runs, any customer discussions underway, and that because this is a substantial opportunity that can come our way as some of these multinationals like Metso and Sandvik are exiting Russia.
No, so that's correct. Though we see also ourselves as a multinational, but Russia and the entire erstwhile CIS region is a very lucrative territory for us, and as we continuously watch the geopolitical situation in that geography, we do have plans to grow, and that growth plan is irrespective of whether any of our competitors or peers stay or exit. But as you rightly mentioned, I mean, with what's happening in that region, it has created a larger opportunity for us.
Sure. Any discussions that are underway, because these companies will be exiting over the next 4 quarters? So any opportunity that you see, and will that result in an accelerated growth maybe a year and a half down the line?
Yeah, so we already are in that territory for over a decade now, and we have existing relationships with customers in that region. What we do anticipate over time is for them to increase their spend with us.
Sure. That is very helpful. Thank you so much for taking my question.
Thank you. In the interest of time, this will be the last question. I would now like to hand the conference over to Mr. Nachiket Kare for closing comments.
Hi. Thank you, everybody. Thanks for participating on the call and driving an in-depth discussion with the management. We really appreciate all your questions. For any queries, you can get in touch with us. We, Orient Capital, are investor relations advisors to Tega Industries. Our details are available in the presentation. Again, thanks a lot for the management for their time, and thank you, everyone. Please take care. Have a nice day.
Thank you.
Thank you. Bye. Thank you very much. On behalf of Tega Industries, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.